Taxation of the shareholder in the S corporation situation is very similar to taxation of the partner in the partnership and taxation of members of the LLC. The pro rata share of ordinary income loss and separately stated items are reported by each shareholder on their individual return. And the pro rata share here is determined using the per day per share method. That allocates equal portions to each day in the tax year. It allocates an equal portion of the daily amount to each share of stock outstanding on each day. And you total the daily allocations for each share of stock, totaling the amounts allocated for each share of stock held by the shareholder. And if shares are sold during the year, the transferor reports earnings allocated to those shares through the day of transfer. What this basically means is we don't look at the date on which items of income, deduction, loss, expense happen. We look at the end of the year at the results of what happened and allocate them on a per day per share method. So as long as a shareholder owns a share on that day, they get a proportional allocation of that item, of that tax item, income, expense, deduction, loss, things like that. If a shareholder terminates or substantially reduces his or her interest, a special election allocating items of income and loss according to the accounting methods used by the S Corp is made. The S Corp tax year is divided into two parts, ending on the day the shareholder's interest in the corporation terminates and the last day of the S Corp's tax year. So we have two different parts of the year. Income that is passed through to shareholders. All income is passed through to shareholders. All items pass through and they retain their character. And shareholders may qualify for the qualified business income deduction. Loss and deduction also pass through to shareholders. Again, this is just like partners. Ordinary loss and separately stated deductions pass through to shareholders and they retain their character. The allocation of loss conforms to the rules of daily allocation, that per share per day method. And if allocated ordinary loss and other separately stated losses and deductions exceed the shareholder's income, the excess may create a net operating loss at the shareholder level. The loss deduction is limited to the sum of the adjusted basis of the S Corp stock plus the adjusted basis for debt owed directly by the S Corporation to the shareholder. The stock basis for loss is as follows. You increase that basis for any capital contributions during the year. You increase that basis for ordinary income and separately stated income or gain items. You decrease that basis for distributions not included in the shareholder's income. And you decrease that basis for non-deductible, non-capital expenditures. S Corps also are subject to special shareholder loss and deduction limitations. The at-risk rules, the passive activity limitation rules, and the excess business loss rules. These are all very, very similar to that of a partner in a partnership. So under the at-risk rules, the shareholder can only deduct a loss from a particular S corporation activity to the extent the shareholder is actually at risk in the S corporation's activity at the year end. The passive activity limitation rules say that the S corporation shareholder must personally actively participate in the business to avoid those rules. So you've seen these before at the individual level and at the partnership level. In order to take a deduction for an activity, it can't, a deduction above the income, so to create a loss, the activity can't be passive. There must be active participation. And then the excess business losses rule says the S corporation shareholder is subject to these provisions just like partners in a partnership. In question 37, John owns all the stock of Lucas Corporation, which is an S corporation. John's basis for the 1,000 shares is $130,000. On June 11th of the current year, John gifts 100 shares of the stock to his younger brother Michael, who's been working in the business for 1 year. Lucas Corporation reports $125,000 of ordinary income for the current year. What amount of income is allocated to John and to Michael? So again, we're going to use the per share per day method to allocate these items of income and expense. And notice that John was the sole shareholder of the S Corp until June 11th. All right. So if we did the math here, I did not do the math, but John owned all the stock for 162 days of the current year. So that's January 1 to June 11th, I believe. Yes, January 1 to June 11th, which is 162 days. After that, Michael became a shareholder, and Michael was a shareholder for 203 days. So first doing John's election here, we had $125,000 of income to allocate. And so for 162 out of 365 days, John gets all of that. But for 203 out of 365 days, John only gets 90% of that. And we get 90% because John owned 900 of the 1,000 shares after June 11th. And then for Michael, after June 11th, so for 203 days of the year, Michael owned 100 out of 1,000, so 10% of the shares. So Michael's allocated 10% of the $125,000 for 203 out of 365 days. And to calculate the shareholders' basis in their investment, we start with the initial investment, and those rules are the same as we have done since the beginning of individual income tax. Our basis is what we paid for something, and it's based on how we acquire it. So if we didn't pay but we received it as a gift, those gift rules will apply. If we didn't pay and we received it as an inheritance, those inheritance rules will apply. So we start with our initial investment. We increase our initial investment by any additional capital contributions, the allocable share of ordinary income, the allocable share of separately stated income and gain items, and then we reduce the basis by distributions excluded from the shareholder's gross income, the allocable share of any expense not deductible in determining ordinary income and not chargeable to the capital account, the allocable share of ordinary loss, the allocable share of any separately stated loss and deduction items, and from there we get the adjusted basis for the stock. And down here in this note, I tell you that basis adjustments are determined at the close of the tax year and allocated using the daily method. If we have shareholder debt, if the shareholder's basis in the S corporation is 0, the basis in any S corporation debt owed to the shareholder is reduced by any remaining loss and deduction items. So if we have already exhausted our basis in the S corp, and we have the S corp owes us a debt, then we will start reducing the basis of that debt by any loss and deduction items. If we have more than one debt that's owed to us by the S corp, we reduce the basis of each debt on a relative adjusted basis of the debt. And then any positive adjustments in the future would first restore that debt basis back to where it was, and then it would start increasing the shareholders' basis in the S corporation. And so the general rule is an S corp with no earnings and profits. So if it's an S corp that's always been an S corp, this is the rule that's going to apply. A general rule, no earnings and profits. So distributions under the general rule of no earnings and profits are not taxable to the extent of a basis. If a shareholder has a basis in the S corp and they receive a distribution, those distributions are not taxable. If the basis is 0, any further distributions are going to be treated as a gain from the sale or exchange of stock. And the basis is going to be measured after any positive adjustments but before any negative adjustments. So at the end of the year, we increase the basis by any positive adjustments, but we don't reduce it by the negative adjustments. If property is distributed instead of cash, we treat it as though it's sold for fair market value at the corporate level, and the S corp would recognize any gain but not loss. If the corporation has an earnings and profits balance, the distribution tax treatment is going to be dependent on the value of an accumulated adjustments account. And you can read about that in your textbook. I'm not going to focus on that in this course, but it is a more complicated allocation structure.